Good afternoon. My name is Brian Cruz, and this is my valuation for Alphabet Inc. So, Alphabet ended 2025 with about $403 billion in revenue, 38.5% EBITDA margin, and $126.8 billion in cash. What stands out to me is that they produced those numbers while also absorbing a massive AI infrastructure build out. So my thesis is this: Alphabet is still a dominant platform business, but it's also becoming an AI infrastructure company. The market price is far above the DCF calculated in this model, but I don't think that gap is random. I think the market is pricing in the optionality that a 5-year DCF can't really capture. Historically, Alphabet has been extremely strong. They've been an extremely strong compounder since 2015. Revenue is up about 5.4 times. EBITDA margin has averaged around 34%. The important point is that margins have not compressed as the company has scaled. If anything, they have strengthened. That tells me the core business still has operating leverage. The newest data point supports that. In Q1 2026, revenue grew 21.8%. So I use that as my anchor point for my forecast instead of assuming that the business suddenly slows down immediately. Moving on to my 5-year forecast assumptions here. Every driver is sourced directly to the 10K or the 10Q. Revenue growth is tiered: 20%, 17%, 14%, and then held down at 13% for 2029 and 2030. I front loaded that off the Q1 actual. So the most important assumption here in this 5-year forecast is going to be the CapEx. Alphabet is essentially becoming an AI infrastructure build out. Data center, servers, DPUs, cloud capacity. So I kept CapEx elevated quite early on, around the Q1 run rate for 2026, then tapered it off as the build out matures. CapEx exceeds depreciation every year, which means this is not maintenance spending, it is growth investment. And that's why we see cash flow pressured even while revenue and EBITDA stay strong. So looking forward, the model projects revenue reaching about $823 billion by 2030, which is roughly double the 2025 level. At the same time, cash builds from $126 billion to about $275 billion. So even with the elevated AI capex, the model still shows that Alphabet is generating enough operating cash flow to keep strengthening their balance sheet. For the discount rate, I used CAPM to estimate Alphabet's cost of equity. The risk-free rate is 4.39%, and I use an equity risk premium of 5.9%. For the beta, I didn't just take Alphabet's raw beta. I unlevered the betas for all 10 peer companies, and then I used the medium asset beta, which came out to 1.23. Putting those together gave me a cost of equity of 11.66%. And then I used that as the discount rate deliberately. Alphabet is in a net cash position, so debt isn't a major part of the capital structure. And because of that, there's not really a meaningful debt weighting or debt premium to include. So the cost of equity is going to be the cleanest proxy for WACC in this model. So this is the core of the valuation here. In 2026, free cash flows did turn negative at about negative $32 billion. I do want to be clear though, this isn't because the operating business is collapsing. The core business is still producing strong operating income. The negative free cash flow comes from timing. Obviously, Alphabet is hitting peak AI infrastructure spending right now, and that's very early in the forecast. So the model is also including the Waymo revaluation impact, the AI funding. Basically, the cash flow is being absorbed by investment, not by weakness in the business. By 2030, free cash flow does recover to about $70 billion. After discounting those cash flows and adding the present value of the terminal value, I do get an enterprise value of $589 billion. Then after adjusting to equity value and dividing by roughly 12 billion shares, we arrive to an implied price per share of $53.67. I also did stress test the DCF using different WACC and terminal growth assumptions. Across 25 scenarios, the implied value ranges from about $40 to $82 per share. And importantly, every scenario still comes below the market price. So the gap here isn't caused by one aggressive input or one overly conservative input. The DCF is consistently lower because of the structure of the model. High near-term capex, discounted cash flows, and limited recognition of value beyond the 5-year forecast. So I calculated the terminal value in two ways. The first method is the growing perpetuity method. I used a 3% long-term growth rate, got a terminal value of about $835 billion. That's my base case. The second method I used was the exit multiple method. I applied the peer average EV to EBITDA multiple of 23.5 and then multiplied that by the 2030 EBITDA estimate. And that gave me a terminal value of about 7.5 trillion. That's a pretty big difference. So the real question here was, what growth rate is the exit multiple actually implying? And when I set the two methods equal and solved for the implied growth rate, the exit multiple implied about 10.6% free cash flow growth forever. And that's a big problem. 10.6% perpetual growth rate isn't realistic. It assumes that Alphabet can grow free cash flow faster than the overall economy indefinitely. So I ended up going with the 3% growing perpetuity as my base case. The exit multiple captures what the market might pay for Alphabet's near-term AI and platform optionality, but I don't think that's the kind of aggressive growth that belongs in the terminal value of a DCF. So then the question here is the market wrong? And to test that, I valued Alphabet using pure multiples. On a PE basis, the valuation does center around $354 per share. My most conservative range here is the EV to EBITDA, which is centered around $294 per share. And the current market price of $313 falls inside all four comparable company ranges. So against peers, the market price isn't irrational. The difference is that the DCF is just more conservative. It does penalize Alphabet for, its elevated capex and near-term free cash flow pressure, while the multiples reflect how the market is valuing similar platforms and AI-exposed companies today. So I did a deep dive into the balance sheet. The largest asset that I straight-lined was investments and advances. This mainly captures Alphabet's longer-term investments, including things like Waymo and other bets. The largest liability that I straight-lined was the other current liabilities, which includes items like deferred revenue and DOJ fine accruals. And for both accounts, I forecasted them as a percentage of revenue. And that percentage does decline over time, reflecting the idea that these balances should not grow faster than the core business indefinitely. I also tied the treatment back to the 10K footnotes, so these assumptions aren't just arbitrary. This slide shows the tornado sensitivity on the main cash drivers. The biggest drivers are CapEx and EBITDA. And that makes a lot of sense because CapEx directly reduces free cash flow, while EBITDA drives the operating cash flow that funds the business. DPO had the smallest impact. The reason being is that payables are tied to the cost of goods sold, not total revenue. So even a 20-day swing in DPO would only change the valuation by about $1.30 per share. For comparables, I used 10 peer companies. The group includes large cap platform businesses along with AI exposed companies to help capture where the market is pricing growth. Alphabet's liquidity is quite strong with a current ratio of 2.01. R&D is about 15% of sales, and that really supports the idea that Alphabet is still investing heavily while maintaining a very strong balance sheet. One adjustment I did make was with Roku. I excluded Roku from one of the valuation multiples because it was quite a bit of an outlier, but I kept it in the beta calculation because it still helps represent the risk profile of digital advertising and platform businesses. So let's go over some of the key risks as well as some updates from the 10Q. So the main risks that Alphabet is currently facing are regulatory. The two high-risk items are the DOJ search ruling and the ad tech judgment. So Alphabet recorded a $15.6 billion fine accrual. These are not just theoretical legal risks, they're already kind of showing up in the financials. The medium risks are more about like execution, the biggest one being whether elevated capex actually earns an attractive return. Alphabet is spending pretty heavily on AI infrastructure, so the model depends a lot on the investment eventually converting into growth. The second medium risk here is the competitive pressure in AI. If competitors move faster, Alphabet may need to keep spending aggressively just to defend its current position. And then one additional item is the $32 billion Wiz acquisition. It did appear in the Q1 10Q and closed after my base model, so I did flag it as important, but I left it outside the valuation as a whole. So here is my final view. My DCF gives us an implied value of $53.67 per share. The comparable company analysis clusters much closer to $300 per share, and the actual market price is $313. So on a pure 5-year DCF, Alphabet screens as overvalued, but I don't think that the market premium is random, and I don't think that it is necessarily mispricing. I think the market is paying for optionality that my 5-year model can't capture in the DCF. That includes peak capex eventually normalizing, Waymo scaling, Google Cloud continuing to take share, and Alphabet's AI infrastructure producing returns beyond the explicit forecast period of 5 years. So my conclusion is this. It's that $313 is not justified by my base DCF alone. It is a bet on post-horizon optionality. And given Alphabet's balance sheet, platform dominance, and AI positioning, I think that's a very defensible bet, and it's a very defensible price. And then this is my appendix, just documenting some of the integrity checks. The balance sheet ties every year, CapEx exceeds depreciation throughout. Every figure traces to the 10K, 10Q. Yeah, thank you very much.